Welcome back to the channel, everyone. Today I want to talk about how the APE FTDs have been covered with more FTDs and more borrowed shares. I want to talk about how this is actually a legal loophole to ensure that APE was removed from the threshold list. So stay tuned and let's make some money. And I want to dive straight in with the key information. So I basically want to explain how this legal loophole actually works, what's actually happened to the FTDs, aka if they're gone or just hidden, and what we can do about it. Dodger Island tweeted saying, "I had no idea you could cover up FTDs with more borrowing. Doesn't that defeat the purpose of having to cover FTDs in the first place? And doesn't it defeat the purpose of having a regulation SHO threshold securities list?" And he said, "Ban dark markets, FTDs are theft." So the premise of this loophole actually started from a tweet from Ortex. They replied saying Ortex has no control or bias over what the exchanges include on the threshold list. And they said, "We simply provide the facts and try to help investors understand the market mechanics." They said, "Keep in mind that FTDs can be settled by borrowing stock to deliver versus buying in the open market." Basically saying the way to cover or the way to remove a stock from the threshold securities list isn't just by buying shares in the open market. You can actually settle FTDs by borrowing more shares. AKA you can settle FTDs with new FTDs. Basically, there's a little loophole in here that allows the second batch of FTDs not to be counted as real FTDs for the threshold list, thereby removing the stock from that threshold list. Malignant Capitalism replied saying, "Wait, so they can actually borrow stock to deliver? Seriously? So my APE could be someone else's borrowed shares. How is that even legal?" So I've basically scrolled through regulation SHO and found this exact legal loophole that allows them to cover FTDs with more FTDs. So as part of regulation SHO rule 203B, there's a separate sub-rule underneath that called rule 3210 threshold securities list. So it basically says if the fail to deliver position is not closed out in the requisite time period, aka those 5 days before it ends up on the threshold list, or the full 13 days, a clearing agency participant or any broker-dealer for which it clears transactions would be prohibited from effecting further short sales in the particular specified security without actually locating shares to borrow or entering into a bona fide arrangement to borrow the securities until the FTD position is closed out. Basically saying these hedge funds, these broker dealers and these market makers can't enter into a new short position unless they first located the shares themselves, aka they aren't creating an FTD, or they actually enter into a bona fide arrangement to borrow. Basically, they can create new FTDs if they enter into a bona fide arrangement to borrow. Now, obviously, this bona fide arrangement to borrow is only applicable to those market makers that receive the bona fide market maker exemption. Basically, if you're a hedge fund that hasn't actually located shares, you've then created an FTD. But if you're a hedge fund that speaks to a market maker and obtains this bona fide market maker exemption, you can create more FTDs and use these new FTDs to cover the old ones. But obviously, because these new FTDs have been created under the bona fide market maker exemption, they basically don't count as FTDs for the threshold securities list. Therefore, they can use these new FTDs to cover the old ones, ensure that APE is removed from the threshold list, and they can still create new FTDs, just under the bona fide market maker arrangement. On top of this, it also says to the extent that the participant can identify the broker dealers that have contributed to the FTD position, the requirement to borrow or arrange to borrow prior to effecting further short sales may apply only to those particular broker dealers to which the participant has allocated such fail to deliver positions. Basically, only the hedge funds or broker dealers or market makers that have so far created FTDs are the ones banned from creating new FTDs. Other brokers or other hedge funds or other market makers are plenty fine to create new FTDs. So therefore, we've got two very easy ways here for a stock to be removed from the threshold list. Either A, they create new FTDs under the bona fide market maker exemption and use these FTDs to cover the old ones, or they basically just create more FTDs under a separate broker or a separate market maker. Guys, if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. Moomoo is currently giving away 13 free shares, which is the most free shares that Moomoo has ever given away, up to a whopping total of $26,000. Moomoo is very easy to use, it's incredibly customizable, they've got tons of technical indicators and advanced charting tools. From Moomoo's latest customer agreement, they officially state that Moomoo does not sell your order flow to market makers like Citadel, and therefore Moomoo is brilliant for buying those AMC, those APE and those GameStop shares. Now you may say, okay, Tom, how can one of these hedge funds create new FTDs under a brand new market maker? Well, as Coin tweeted, he said classic YouTubers are missing the bigger picture. Citadel may be liquidating one of their specific funds in Europe, but they've just created a brand new fund and they've executed a ton of ISDA agreements with banks in August already. And he said that's a lot of money to borrow with stock as collateral, or a lot of money to use to create new FTDs. As Biggins has tweeted, while Citadel Europe LLP has just been closed down over in the UK, there's a brand new company that's popped up called Citadel Securities Finance UK Limited. And they've just entered into a number of new ISDA initial margin agreements with JP Chase, with Merrill Lynch, and with a bunch of other security providers as well. So there's a perfect example of how a market maker like Citadel has created a brand new entity or a brand new market maker to help these hedge funds create new FTDs. Now, on top of this, something else I found out that was very, very interesting is that the legal short interest data provided by Ortex and provided by S3 partners is only calculated based on the shorted shares from these hedge funds, not from these market makers. As Beats by Jay tweeted, he said, do companies who provide retail with short interest data, aka S3 and Ortex, include short transactions carried out by market makers? Well, Ihor from S3 Partners said, I don't have a clue how other firms get or calculate their numbers, but we report shares shorted that are on a broker's books at the end of the day. Whether the short has settled or it didn't settle is irrelevant. It's the trade date position that we are reporting, not the settlement date. aka S3 Partners and Ortex only report shorted shares that are held on a broker's books. They don't report shorted shares held by market makers, and they don't report shorted shares held by individual trading platforms. Therefore, it's very likely the legal short position is actually much, much larger, as they're not including legally shorted shares from these market makers, which likely have the largest short share positions. Especially when you factor in that these market makers are using their bona fide market maker exemption to create new shares to be shorted. But I find it very, very interesting that these additionally created shares aren't actually included in Ihor or S3's or Ortex's calculations. Now, Dave Lauer has also tweeted saying it seems like a good time to revisit the IMC enforcement case for FTDs and regulation SHO violations. He said, I've seen two main reactions to this. Number one is no reaction by the mainstream media. The press appears uninterested. Industry wants to sweep it under the rug. And he said the payment for order flow industry wants this case to be swept under the rug because it's a really big deal. This is essentially the SEC declaring that OTC market making, aka Citadel's market making, is not eligible for the locate exemption under regulation SHO, aka Citadel shouldn't really qualify for the bona fide market making exemption. He said, as a quick reminder, in January I made a point along these lines. Citadel and Virtue are not market makers, they're high-speed speculators. He said what they do is not bona fide market making and should not be treated as such. He said the SEC is quite clear in its action. Bona fide market making is something that happens in a displayed venue, where continuous quotes are communicated and represented in a way that makes them widely accessible to investors and other broker-dealers. He said the SEC precedent means the OTC facilities run by Citadel and Virtue do not qualify for the locate exemption or for the bona fide market maker exemption at that. He said they should need to find and locate shares prior to short selling, and they're not doing so today. This is the definition of naked short selling, selling shares they do not own and have not located. And he said it's hard to imagine that these firms are not under active and intense investigation right now, and are fighting tooth and nail against the SEC and maybe others on this critical issue. If the SEC is successful, the OTC market making business could be ended. And that means aka no more infinite liquidity from the infinite liquidity fairies. So what we need to do is encourage the SEC to investigate Citadel and Virtue just like they investigated IMC Chicago, and to determine that Citadel is not eligible for this bona fide market maker exemption. If Citadel no longer receive this bona fide market maker exemption, Citadel can no longer help these hedge funds create additional FTDs under that bona fide market maker exemption that don't qualify for the threshold security list violation. If that actually happened, APE and AMC would remain on the threshold securities list, as there would be no way for these hedge funds and for these market makers to clear or to cover up or to hide these FTDs. And as a result, as Spence tweeted, he said it's pretty clear why people have been telling you to sell your APE shares. Obviously, APE was on the threshold securities list from its launch day on the back of a failed distribution. He said hedge funds needed you to sell bad. Obviously, these hedge funds and these market makers have been struggling to create synthetic APE shares, as APE has only been tradable for 2 weeks. And he said some YouTubers have been so sus in when and how they push their theses on the community. But obviously, even though these FTDs can actually be covered by new FTDs and it does remove the stock from the threshold securities list, it doesn't actually remove or reduce the number of FTDs. It just replaces like with like, aka replaces one FTD for another FTD. Therefore, the number of FTDs will be the same, if not increased. It's just simply removed from the threshold list. Obviously, this still goes to actually expose the true number of FTDs and exposes that the FTDs are consistent and are inflated and are indicative of naked or manipulative short selling. Obviously, if Adam Aaron can see tens of millions, if not hundreds of millions, if not billions of FTDs for APE every single day since release, even if it's not on the threshold securities list, it's still obviously manipulative short selling. And at that point, Adam Aaron can do something about it once and for all under Rule 10b-1. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.